you're comparing the volatility to the honey badger. Fun reference there. He says it just doesn't care. But what does the option market care about? Is the option market seeing the same volatility ahead? And if not, in what areas?
Yeah, what I would say is, volatility has been steadily unimpressed. We felt the visceral kind of whipsaw. So your realized volatility, the volatility that occurs on a day-to-day basis, is high. And usually, Frank, that feeds into future expectations of volatility. We aren't getting that. We aren't getting an increased demand for downside protection. We're also not getting an increased demand for upside swings either. The narrative around this, what people are saying is the reason is that largely investors have taken their ball and gone home. They've degrossed they've de-risked. And so the options market, which typically is used in a portfolio that's fully participated in, is not really participating now. I think that's part of it. And I do think that the options market is saying that we are at or near the bottom right now.
All right, so you're saying there's a number of signals, including ETFs that track bonds. The LQD is one you highlight, also the HYG. You're saying you're seeing substantial call buying. When you see substantial call buying for these ETFs, what does that mean?
Yeah, so when I speak to volatility, initially it's always on a market level, the S&P. Kind of under the surface, when you look at different ETFs like HYD, LQD, TLT, these bond proxy ETFs, you are actually seeing a lot of upside being bought. Another section, which is interesting to me, is you're starting to see that happen as well in China. So you're seeing that in ASHR and FXY. So essentially, the way you can read the tea leaves is people are starting to dip their toe and perhaps, say there might be an inflection point in these names below the surface, even though on a market level, there's really no conviction either way on either the upside or the downside.
So you said there's no conviction on the upside or the downside. So I'm a little bit confused because you're saying the call buying is going up. So that kind of signals that people believe that we're hitting the bottom, right?
Yeah, so that is more on the subsector level I mentioned. So your FXI, your ASHR, your bond proxy ETFs. On the S&P 500, what I would say is going on is there's sort of a lack of either. If you actually look at kind of the volumes on both sides, as well as the demand for hedges, it's not really showing conviction either way. I think people read it different ways. They essentially say, okay, Frank, because we don't see all that much in hedges, I think that's it in terms of the bottom. But other people could argue it's simply because people have de-risked and degrossed, so they're not participating. I think what that frames up is this idea that either an up crash or a down crash in the market right now is really not being priced in. So if we rip up or if we sell down even more, neither one is being priced into the options market right now. So I think my statement is more about what tail is kind of more going to happen. And right now it's obvious complacency from the options market on both sides.
All right, so volatility hasn't been that much of a factor, but we have a lot of big events coming up. I mean, we have jobs report coming up on Friday that could tell a lot about the economy. Also, the Fed possibly are expected to raise interest rates, a strengthening dollar. Can we see, or do you expect us to see more volatility as we go ahead with all these other things going on and obviously inflation continuing to rise?
So if you look to what has actually happened when these data points have appeared in the past, it hasn't really taken your applied volatilities all that much higher. Now, part of that is because it's on an absolute level so much higher than it is last year in general that it's kind of harder to kind of kickstart it even further. But that said, historically catalysts are things that are supposed to spur volatility to higher levels, but we're also entering the seasonally slow month for volatility. So outside of this year, I would say, as a derivative strategist, you usually tell your clients that a great time to sell volatility is actually June, July, and August. That seasonally is a time where if you're an overwriter, that's very compelling. Now, I don't know if that is setting up for this year or not because of one, what you said, and two, because, we're trying to figure out right now, are we in a bear market rally or are we truly in a bottom? Because that has not been priced into the market, the catalyst may be something that actually takes your complacency and kickstarts it.
All right, well, first day of June right now, futures pretty much flat, nothing spectacular either way. Give me the last word before we head over to Squawk Box. What do you see coming up with the options market? Do you see people continuing to play it to the upside or the downside in June?
Here's what I'll say. I was just in Las Vegas for a derivatives conference, and one thing that I spoke about with our panel is, everyone was prepared for this. It's kind of 15% move down. It was a very orderly sell-off, if you will. Nobody's prepared for a down crash even more, and nobody is prepared for the up crash. So in that sense, the fact that our VIX levels are sub 30, at a 26 handle is fairly compelling if you are involved in the market and you want to own tails in either direction.